What we're going to be talking about this evening is inflation, a lot about inflation and the impact that this inflation is going to have on the stock market. There's a lot of bullish optimism out there in the stock market. And so much so that I actually booked half profits on a short position of the Qs today because I think they're going to try to spike them up higher tomorrow. I'm going to be looking to re-enter that short position. So I'm going to share with you the whys behind why the Federal Reserve may talk dovish but has to act hawkish. So you're going to have the Jackson Hole, Wyoming meeting tomorrow, and you're also going to get tomorrow morning the PCE inflation data. If it comes out hot, you got to expect you're going to have a Fed statement later on in the day that is going to be somewhat hawkish and not good for equities. So stick around. We're going to go over the weekly charts as well. I'm going to share my screen now before before I forget, as I usually do. And like, subscribe. Let's go to comments. Let's wait for people to get in here. And Seymour Rivers, what's up, brother? How are you? Good evening. Larry, these guys don't need to be in Jackson Hole, no doubt. They could have met at Rayo's in Harlem. Absolutely. Rayo's was good enough for Lucky Luciano and John Gotti. Absolutely. I agree. 1,000%. Better food, too. Sound check. Very good. Thank you for that. I appreciate it. Happy Thursday, Lewis. Welcome. All right, we're going to do some chart requests later on. Hold on to the symbols until the end, and we'll create a list, and we'll get to those. Okay, let's jump into it. A lot of data to go into here, and it's important. So why did stocks rally this week? Well, the reason why they rallied is because, as always, bad news is good news. Bad news is good news. What do I mean by that? Well, traders get invested, get bullish. Traders get bullish when bad news comes out because they believe the Federal Reserve has to pause on raising rates. They can't. And I'll tell you why in a moment, why more so than ever, they cannot pause on raising rates. So coming out this week, just to show you that we are in recession. They could redefine it. They could call it a cupcake versus a recession. We're in recession. So the data that came out this week, Chicago PMI, they didn't have a forecast here, but it looks better than the prior read. So we'll give that a thumbs up. The S&P manufacturing PMI, that came in worse than expected. Any number above 50 is a sign of expansion. So manufacturing expanded. A read below 50 is a sign of contraction. S&P 500 Services Index, second consecutive quarter. Remember, the United States is a services economy. Second consecutive quarter, recession. Contraction in the services sector. What else do we have? Durable goods, missed by a mile. So what does this mean? Because you may be saying, wait, whoa, that number's got to be wrong. The consumer has got rising credit. They're spending a lot on their credit cards. It must find its way into durable goods. For those not familiar with what durable goods are, washing machines, dryers, things that have a life expectancy of 5 years, 10 years. So those are your durable goods. So that missed. You can blame it on the housing slowdown, but I would prefer to blame it on the fact that people are spending more on their credit cards on food and energy. Food and energy. What else do we have here? Initial jobless claims. We'll go over that in a minute. Along with continuing claims, we have a chart. Real GDP. I don't know why they said this. Oh, the expectation was, all right, so it came in worse than expected, but it actually was not as bad as the original forecast. So we'll go to that in a minute as well. Tomorrow, again, PCE inflation data. So keep an eye on it. Okay, so let's go to what inflation is, right? A lot of people think that it's because people spend too much. Well, why do they spend too much? Why do they spend too much? Well, they're given free money. So what is inflation? Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. Simple, simple. Then you scroll down to the causes of inflation. An increase in the supply of money is the root of inflation. Well, who does that? The government. Let's take a look at a chart. Here is M2 money supply. These are all the dollars that are in existence. This goes back to 1959. And look at this trajectory. And guess what, folks? After all the Fed rate hikes, where do you think we are in terms of money printing? We'll scroll down to a yearly view. We are just off of all-time record highs. M2 money supply is growing. They continue to print money. So let's go back. Oh, one of the ways that you get inflation in the supply of money is printing and giving away money to citizens. What just happened today or yesterday? The debt forgiveness, student loan debt forgiveness. What else did we just get? We got the Inflation Reduction Act, right? So all of this, the stimmy checks, all this stuff, it's the government that causes the inflation. If they send the money out and they keep rates low so you can't get paid on saving the money, you got to spend it. So that's what's happening right now. The government is our worst nightmare. As long as government continues to print and grow, we will have inflation. So let's take a look at this week's. Oh, I thought I was sharing it. Franklin, thank you. Let me go back. I will share it again. I will do this yet again, and I will do it right. I will do it appropriately. How dare I? Sorry about that. Thank you, guys. Appreciate it. Lewis, Franklin, thank you. All right, so let's go back. Causes of inflation, printing and giving away of money to citizens, M2 money supply. Here is the max view going back to 1959. At current, here we are, just off of all-time highs last seen this past May. Does this look like a federal government that has any plan whatsoever to fight inflation? Are they even aware, or do they care that they are the root cause of inflation? Either way, or either answer makes them either A, incompetent at best, nefarious at worst, because they are intentionally bringing down the standard of living of pretty much every American, with the exception of the top 1%. And those who they proclaim to help the most and care for the most, the lower echelon, the lower tier of society, those who have little to no income, they get hammered the worst. And the people that benefit from the student loan forgiveness program, it's not the poor. It's the upper middle class. So by all means, folks, this is probably going to be one of the last hurrahs for the middle class for a very, very long time. Your kid's got a student loan, get your money. Get your money. Because you're not going to get a handout anytime soon. And beware of taking that money first, because those 80,000 new IRS agents that are going to be coming on people's doors armed, they may be looking to tax you on the money you saved by not having to pay the interest on that debt. Is it so profound? So here we have it. Biden announces student loan relief, which will mostly benefit top earners. So here, I bleed for the guy because I feel his pain. Here's a video.
I'm having her time.
Yep. Hello here. I just want to ask one question. My daughter's getting out of school. I've saved all my money. She doesn't have any student loans.
am I going to get my money back? So you're going to pay for people who didn't save any money, and those of us that did the right thing get screwed.
No, it's not everybody got screwed. When we
Of
started,
course we did. My buddy had fun, bought a car, went on vacations. I saved my money. He made more than I did. But I worked a double shift, worked extra. My daughter's worksheet is 10. So you're laughing. Yeah, that's exactly what you're doing. We did the right thing, and we get screwed.
I appreciate it.
That's all right.
Okay, so there's going to be massive blowback for this. Massive blowback. The poor are not going to be too happy because they're not going to get anything out of it. The people that do are going to be pretty pissed off that they saved their money and now they're being literally spit at in their face. And it's so bad. You know it's bad when you have Nancy Pelosi that came out today or yesterday, I forget what it was, saying that the president does not have the authority to do what he did because technically it's spending money. It's a taxation on the American people. When you print money, it's got to get paid back. It's got to get soaked back up out of the economy. So how are they going to soak that up? They got to raise it. They got to raise interest rates to take that money back out of the economy. The money that is not going to be paid back in student loan debt is going to go into buying new cars, new whatever, stereos, whatever, and it's going to jack up inflation all the more. Ronald Reagan once said, beware of when you have a government agent come to your door and say, I'm from the government, I'm here to help you. It's the worst possible scenario to be in. So you have Obama's chief economic advisor comes out and blasts Biden's reckless student debt bailout. Of course it's reckless. And this is Obama and Pelosi, but still, they didn't stop it. How this is impacting inflation anyway is impacting retailers is startling. Dollar Tree, which raised a year ago, I think it was, raised their dollar store to $1.25 stores. That's a 25% rate hike on prices. They came out with earnings which were okay. They weren't bad earnings per se. But the problem is this, is Dollar Tree, which 1 year ago succumbed to the inflationary wave and was forced to hike its prices from $1 to $1.25, tumbled after unexpectedly cutting its full year profit outlook. The company said a heightened focus on needs-based consumable products was pressuring gross margins. What are needs-based products? Well, usually it's food. And I guess I read in an article, they do sell some food. So I haven't seen it in my Dollar Tree. I guess I have. Yeah, jarred food. Yeah. They do sell food there. So, and as a matter of fact, there's a couple of aisles of it. They're not making the margins on that type of a product. But that's where people are spending their money. Again, it goes back to what I said earlier. You have consumer credit card debt going up like this, yet people aren't paying for durable goods, washing machines, dryers. They're paying for food and energy. This is your standard of living, which is declining. And here's a chart of Dollar Tree. This is going lower. It really shouldn't per se. It's not. It's a very good company, but this is the big gap down. Maybe it'll pause here. Maybe it won't. I'm not quite sure. But the momentum indicators are implying that we may go lower. Big distribution by institutions today. Doji star formation, a sign of indecision, means that there's a tug of war going on between bulls and bears. If you're long of Dollar Tree, I wouldn't dump just yet. I would wait a couple of days. They may rally to fill the gap at 162.50. Then I would probably exit the trade, take a step back, and say, okay, where to from here? If we break out to new higher highs, jump back in. If we break down to new lower lows, avoid like the plague. Moving on. So we had a bond auction today, a 5-year treasury auction, and it was so poor that it sent the 10-year yield to its highest level in 2 months. Now, to be fair, you might be saying, well, if the 10-year yield was down today. Yes, but initially the 10-year yield knee-jerked higher in the morning. As you can see here, it hit a high of 3.13. That's the highest level since June, mid to late June. So yields are creeping back up. The bid to cover was ugly, slumping to 2.3 from 2.46 in July and far below the 6-year auction of 2.437. In fact, the expectation for June's 2.28, today's auction, was the lowest bid to cover since February of 2021. Overall, a subpar, if hardly catastrophic auction, and one which sent the 10-year yield to 3.12. It's actually wrong, 3.13. The highest since late June as stocks reversed much of their earlier gains. So this is printed early this morning, so we'll give them a little bit of latitude here. So bond auctions are not going well. Yields need to go up higher, despite what the Fed chair has to say. He does not control long-term interest rates. He controls short-term interest rates. Why the dollar rally is blowing itself out. I was rather surprised this week to see gold and the gold mining stocks. We're going to go over them in a little while. Bear with me. We'll go over the charts. I was rather surprised to see them rally this week because the technicals weren't wonderful, and the fact that the dollar was still so strong was concerning to me. But then I started to see a bit of a correlation between the dollar and at least the gold miners. I watch the gold miners a lot closer than I do gold. And I said, you know what? I'm going to sell very, very near-term covered calls. I'm going to roll out some naked puts. These are selling covered calls is a hedge for the most part. And the selling of naked puts is a bullish play. Now, the selling of naked puts did not go well for us last week. So I just rolled them out into this week. We profited on them this week. I booked profits today, like over 80% profit on that trade. The covered calls, we saw a profit in. And I said, you know what? We have the Jackson Hole, Wyoming announcement coming out today. The dollar is behaving really weird where it's going up and gold is going up as well. That bothers me because if the dollar really drops down tomorrow, that means gold's going like this. And so are the gold mining stocks, and I'll be capped out at $30.50. So I saw a profit on the covered calls. I said, you know what? I'm taking them off. I have a profit. I'm not going to be greedy here. We'll see what happens. The however is, I wasn't so greedy that I didn't hold out for the last penny on the naked puts. In short, we booked some profits. We managed our risk by not being too big in the gold mining stocks. If they go up higher tomorrow, great. If they pull back tomorrow, okay, we could sell naked puts again. We didn't get greedy. We're selling where we want to sell. Moving on. So what's it going to take for the Federal Reserve to fight inflation? What's it going to take? Well, the article here, the headline is, does it even matter? The Fed hikes 50 to 75 basis points. It won't prevent multiple train wrecks from coming our way. They're exactly right. What's going on here is that you're seeing Europe in drought, the United States in drought, South America drought. The coffee harvest down there, we're going to go to a chart in a moment, in a lot of trouble. Franklin, I know you're out there. We have coffee's looking the bomb right now, and we're seeing the price of Arabica beans moving up sharply. So we like that trade, and we're probably going to be a part of it very, very soon. Franklin, who's on here, is usually a part of that already. So the awful truth is that real and potentially very bad, no matter how you twist or turn things. The current scorching European summer is likely to end up in the history books as one of the driest in centuries. Those who have visited the south of Europe in recent months can probably attest: extremely dry fields, trees shedding their leaves, the closure of nuclear plants due to lack of cooling water, blah, 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 blah. And not to mention the Dutch farmers, which aren't allowed to grow anymore. You can't make this stuff up. Talk about self-inflicted damage that we're doing to ourselves. Now, here's where it gets worse. Now, China has joined the drought club. Should the prices force China to increase food imports, this would put further pressure on the global commodity prices. Folks, This is all self-fulfilling. Interest rates are going to go up by themselves, no matter what the Federal Reserve does. And what's the Federal Reserve doing? Here's their balance sheet. Here's their balance sheet. While it's trending down from last week, it ticked back up again. So with all the chest pounding that they've done with regard to rolling off debt off their balance sheet, they've done nothing. M2 money supply, let's go back to it. Near all-time highs. The proximate cause of inflation, M2 money supply. Look no further than this. Look no further than this. We have hardly put a dent in the fight on inflation. So what do we need to do? What do we need to do? What would the chart look like of when the Federal Reserve is doing the right thing at the right time all the time? Let's go to this chart here. This is the Fed funds rate relative to the consumer price index going back to 1955. Focus on this area here. This is when the Fed's funds rate got jacked up by Paul Volcker. He just took a stick of dynamite and blew up the Fed funds rate. He raised the Fed funds rate on a Sunday by a half basis point, like that. Finally, it got so high that inflation was crushed, and then we went into the longest bull market in bonds in history. Now, we're already up here in 1981 terms, in terms of inflation. Where are Fed's funds rates? And for those not familiar with what the Fed's funds rate is, the federal funds rate is the cost of borrowing for a bank from the Federal Reserve. The bank then takes that money, lends it out at 10 times, 10 loans for $10 for each loan they can lend out. So where we're at right now is down here, way down here, resulting in M2 money supply at highs. Fed's balance sheet hardly budged. So this is your government, or I'm sorry, the Federal Reserve is about as federal as Federal Express. The Federal Reserve, for all their jawboning, has done virtually nothing to fight inflation. Could poor coffee harvest send prices even higher? We're going to talk about this for a moment. Here is the Arabica bean futures. This is a bull flag setup. For those folks that are not familiar with technical analysis, this is a beautiful, beautiful setup. You got to, I can't give financial advice. As a trader, I'm going to be buying this chart here, and I'll show you how you could do it in a moment. This chart here is a bull flag setup. This is in all probability going to resolve itself to the upside with a massive breakout. Next price target, highs not seen since 2011, maybe 2010 if we're lucky. The vehicle of choice, Joe. Weekly chart. Look at the massive breakout here on Joe. This is an ETF. It's an iPath, I believe. Yes, iPath. ETF, symbol JO. This is a massive breakout, a beautiful setup. It's a little bit extended here. If you wanted to nibble, fine. But I would rather wait for a retest of $64 per share. Daily view, really quick. Daily view, really quick, Bob. Wrong chart. Here we go. We're a bit extended here. Watch for a pullback. Watch for $64 a share on Joe. Then we will be sending out an alert, getting long of Joe as a bullish bet. So what else is going on out there that is going to cause the Federal Reserve to not be able to cut interest rates anytime soon? Despite the dovish rhetoric they will deliver. They will talk dovish, act hawkish as much as they can, because we have real serious problems. You think it's bad here in the United States? You haven't seen anything yet, because over in Europe, the Great Reset is in full swing. EU-controlled demolition. I'm not going to go through this whole article. It just speaks for itself. This is all self-inflicted damage. I don't think I highlighted anything here of interest. It's all self-inflicted damage caused by the war in the Ukraine, caused by the adherence to World Economic Forum policy and the Great Reset agenda, the Green New Deal, blah, 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 all this woke nonsense. Now, here's what was happening in the UK. UK government warned of civil unrest over people's inability to pay energy bills. They're going to stop paying their energy bills. What's going to happen? This is going to force countries to really speed up central bank digital tokens, basically the digital dollar, the digital pound, the digital euro, and they will take the money directly from your bank account. You'll have no choice. This is from French President Macron, the end of abundance. This is like Obama when he came out, when he was first elected, saying the best days of America are behind us. And for 8 years, that was true. We had a few good years under Trump. Now we're back to America's best years are behind us. So here's basically what it boils down to is on Wednesday, we reported that the EU chief, Joseph Borrell, warned that the wary EU population would have to endure deep economic pain and severe energy crunch while carrying the citizenry the bear of consequences with continued resolve. Why? Why? Because of global climate change, which they can't measure. First, it was global cooling back in the 70s when I was a kid. Then it was global warming in the 80s and early 90s. Now it's climate change because they don't know which direction they're going to take. So they are forcing people to adopt the Green New Deal in Europe. Here in the United States, it's coming as well. And they're using the banner of the war in the Ukraine as a reason for why people need to suffer for freedom. While the Ukrainian government, I feel bad for the Ukrainian people, all they needed to do, Zelensky, hey, you got Russian tanks on your border, go out to a microphone right now, or we will stop aid. As a matter of fact, we're going to dump $1 billion into an offshore account for you. If you need to flee the country whenever you're ready. What you're going to do is you're going to go out to a microphone right now. And what you're going to say is that we are neutral. We will not be joining NATO. The Russians would have backed down. They would have not sent tanks across the border. We chose not to do that. We asked for this war. We asked for this crisis. We got it. And now populations are waking up and the governments in Europe are freaking out. And it should be noted that French President Macron was part of the new leaders, young leaders club of the World Economic Forum, along with Justin Trudeau, Zuckerberg, all these familiar leftist names. Fast forward to this country where the lawlessness is just immeasurable. I can't watch Tucker Carlson anymore. He's doing a great job reporting. It just makes me sad to watch Tucker Carlson. FBI leadership ordered agents not to investigate Hunter Biden laptop. We know this, but I'm developing a trend line here. Biden White House directly facilitated FBI Mar-a-Lago raid. They have evidence now that you have the Biden administration, through all their denials of influencing the Justice Department, they did just that. They are guilty of weaponizing the Justice Department, forcing them to raid a former president's home in search of evidence for a crime not yet committed, or maybe committed, but they need the evidence to find it out. They're trying to back into a crime, and they're going to eventually find it. They have to indict the guy. It's exhausting. GDP, we already went over this. We're going to skip this. Just so the point of focus here, GDP was revised. It was changed by a basis point, not much. We're still in recession. But the prices paid index is just through the roof. The highest going back to, I think it was 1981, 41-year high. Incredible. All right, initial jobless claims. The trend continues up higher. Remember, was it last week, the week before, we had the astonishing growth in jobs numbers. That was the establishment survey. And you have two surveys that are released, the establishment and the household. The establishment survey came out with a big beat on jobs. The household survey came out with a big miss on jobs. And if you take a look and say, okay, which was right? Well, it certainly looks as if the establishment survey was rigged because they double counted people holding two jobs rather than just getting one job. They double counted people. So you're seeing the trend in unemployment continue to rise up, continuing jobless claims moving up higher. And this is what I wanted to go to earlier. I already did this. Okay. I thought I had something else here. Let's go to the weekly charts. First, let's go to comments. All right. Dixie looking to roll over. Fractals on the indices look similar to 1973. Interesting. Franklin again. Hello, sir. Pete. Yep, it grew. The trend is still down. I'm waiting to see if it breaks out or breaks down again to new lower lows. It means it controlled the evolution of the economy to usher in AI. Yeah, I guess you're right. Paul, hello. Pete. Yeah, sorry about that, Pete. Order out of chaos. Yes, correct. Basically what they want people hungry, right? They want people hungry so that they can do what they're doing, which is pilfering whatever's left in the treasury. And what I mean by what's left in the treasury is all they can do now is print, steal, shovel that money offshore somewhere and have the helicopters ready because there's going to be pitchforks in the street at some point in time and they know it's coming. That's why they want the guns. That's why they want guns. Canada's already doing it. All planned, yes. Middle class going bye-bye, yes, no doubt. Yeah, but this is worse, though. This is worse than 1973. 1973, you had the Vietnam War that was really driving everything. You had guns and butter out of Lyndon Baines Johnson administration. He wanted to give out goodies, the welfare state, the Great New Deal. Not the New Deal. I forget what it was called. Anyway, he wanted to give away goodies, and that was to lock in the vote. Same thing that Biden's doing. So to a certain extent, you're correct. But Vietnam was the other problem. Was guns are buttered traditionally with this country. If we weren't at war, well, we saved money. We got ready for the next war. Back then, they wanted both war and social spending. And that's when everything really started to go where we're at right now, slowly, surely. They took us off the dollar, the gold-backed dollar. Reagan also said, you think government creates problems? Wait till you see. Yes, that's great. Yeah. Wait till you see the solution. Quantitative tightening, yep. Remember when Christie shut down the GW? Yeah, right. I do remember that. It's backstabbing prick. Bob, you know the markets are going to rip tomorrow. Always does the opposite of people's expectations. I covered half shorts today. And I'm not even net short of the market, but I did have a hedge on. It was profitable. I agree that we're probably going to move up higher. The only caveat tomorrow is you have the PCE report that comes out before Jackson Hole. If it comes in hot, be careful. It's probably not going to because it's not going to calculate in the renewed move higher on energy prices. But I think you're right if it comes in as expected or less hot. So, yes, and that's why we took a portion of our short cues off the table. We're going to look to re-enter that, though. My tinfoil hat may be on, but I think governments do stress tests on the public. No doubt about it. No, they pressure, pull back. Pressure more, pull back a little bit. They never give up all the real estate they took, though. It's the boiling frog effect. So they keep the temperature just below boiling, and before you know it, you're cooked. Trader Isaac. Hey, brother. How you doing, pal? Welcome aboard. Okay, let's go to the weekly charts. And before I get into these, let's say one thing, as I always like to say, and that is these are weekly charts. It's Thursday night. We have one trading day left to go. A lot can happen. So take what I have to say with a grain of salt. It could all change by the end of business tomorrow. Frequently on Saturdays when we do the week ahead commentary with members, something has changed. And we discuss it and we reevaluate our strategy as we move into the new trading week. But our new trading week has already begun. It's begun by having this conversation. It's also begun by us going over the weekly charts to see how we are probably poised to close out the week. Now, we're going to start off with the yield curve, which is a monthly chart. Now, in times past, I've talked about a yield curve which has been very, very weak and has been inverting. It is still inverted. The however is we are well off the lows of the month. And I've always said, don't worry about the inversion of the yield curve. Worry about when it begins to steepen and go back up higher. And sure enough, we're beginning to see signs of a steepening. What does that mean? Yields, 2 years versus 10 years, going up. What are we seeing on the month? We're still negative on the month, but we are certainly more closer to the highs of the month than we are to the lows. Weekly view. And by the way, for those folks that have taken the bait and swallowed the new definition of recession, the yield curve has called every single recession except for one since 1955. When it inverts, you're going into recession, or you are in recession, which we are. Now, on the week, we're down on the week. I think we're going to put in a higher low, and we're going to move up higher. Beware of higher yields, folks. 10-year yield. We broke out 3 weeks ago. We've had 2 continuation breakouts. This is not good for high beta stocks, especially stocks in the ARK fund. So if you're out there saying, Jesus, this stock or this fund is beaten up to high heaven, be careful. Yields are going up higher. Most of those companies do not make money. The only reason why they're still in business is because they roll over their debt into new cheap money. The problem is money is becoming more expensive, and they need to show a profit to get a new round of funding, or they need to dilute their shares. So be careful with these stocks that are not making money and that are high beta, meaning high volatility, because the rug could be pulled out from underneath them at any time. So the 10-year yield weekly chart is up. Now today, despite the bad bond auction, yields pulled back. And I mentioned this, I expected this on Market Wrap, which I released this morning, pre-market. I should expect a pullback on the 10-year yield, probably a retest of a 3 handle. We're still at a 3 handle on the 10-year yield. That is not good for technology stocks. Be careful if we rally in the next few weeks, which I think we're going to do, to higher highs. This all fuzzy feeling, the pixie dust and lollipop feeling that you get with a bull market, it's going to vaporize once we hit 3.13 on a closing basis. That was the intraday high today. So be careful. Don't get lured in. The TLT, 20-year bond ETF, off the lows of the week. Is this a higher low? Maybe. What does that mean for my thesis about yields are going higher? It's not good. But it looks as though right now they're going to try to defend support. They're going to try to keep yields where they're at. But if we do, in fact, break down below 107.71, folks, you had better bet yields are going like this on the 10-year and equities are going this way. Be careful, because stocks are not cheap. The tip market. Now, this is interesting. This is interesting because the tip market, Treasury inflation protected securities, normally if yields were moving up higher, tips would pull back, like here. The tips peaked out back here in November, then a double top here in March. Why would that happen? Well, yields were going up higher. What happened to tips? Well, they figured, the Federal Reserve is going to fight inflation. We don't need Treasury inflation protected securities, so they sold them. So this week, even though yields are higher, and even though they've been higher for the past few weeks, tips haven't gone down. And in fact, this week, they're up. So what that's telling you is that, or telling me anyway, is that investors, which are usually institutional investors in the tip market, they're getting wise. They're looking at the charts I just showed you, showing that the Federal Reserve is not serious about really fighting inflation like Volcker back in 1981, 1971, 1980, 1981. So if they're behind the curve on fighting inflation, so that means that inflation is going to continue up higher, especially with oil prices, natural gas prices, coffee prices, food prices now beginning to move up higher. And I know some of you are out there saying, no, Bob, that's wrong. Oil prices are lower. Wait a minute. I'll show you in a moment. So the tip market is on the verge of a breakout here above resistance. Watch tomorrow's reports. Very, very important stuff. The dollar. The dollar's in trouble. It's still strong, but remember that the dollar is the world's still reserve currency, not as much as it was, and it continues to decline as the world's global reserve currency. The problem is that if the dollar is too strong, the level of global trade declines. If global trade declines, the demand for dollars declines as well. So the need for the dollar to be as expensive as it is at current need not be so. That allows for the dollar to pull back. If that happens, inflation gets worse. Why? Commodities are priced in US dollars. Oil is still priced in US dollars. So if the dollar pulls back on a relative basis, if you're living in the United States, if the dollar weakens, and even if production stays the same out of OPEC in the United States and Russia, the price of oil in dollar terms goes up. The VIX, Volatility Index, very, very important for options traders like me. We look at this a lot. We're up on the week. I kind of figured we were going to get a pullback again today and a filling of the gap. We haven't filled the gap yet. We're close, no cigar. I think what's going to happen here is that we're going to pull back further and we're going to rally a bit higher on equities. Then we're going to reverse. We're going to see a reversal day. And my guess is that it's going to coincide with a reversal bar on the 10-year yield. So you'll see the 10-year yield pull back. You'll see equities rally. Once you see the 10-year yield reverse and close up, meaning open lower, close higher on the day off of a key support level, which will probably be 3%, you're going to see a reversal day on equities. And the VIX will probably, at that point in time, fill this gap, then reverse higher. That does not mean good things for stocks. Now, in terms of how we're closing out the week, poised to close out the week with one trading day left to go, the Dow transports look pretty goddamn good. We have a bullish reversal bar on the week. Volume is horrible. So you don't have institutional buying. You have retail buying. Volume is declining sequentially. The Dow Jones weekly chart. Still a down week. No breakout yet. They tried, but it faded. Down volume light. How do we close out the day today? Up and into resistance. Be careful. Stokes trading down below 50. Rallies tend to fade, folks. Be careful. Don't chase the rally tomorrow. S&P 500 weekly chart. Still down on the week. A bit of a reversal bar. One trading day left to go. Down volume light. Daily chart. A breakout above resistance. Volume rose versus yesterday, but it's a very, very light volume. So be careful. All up days are not made equal. The candlestick looks beautiful. We opened down. We closed up right at the highs of the day. It was a strong close. Bravo. Bravo. There's only one problem. You didn't have any institutions buying today. You had a lot of traders buying. the triple Qs. Now, closed out the day yesterday, 1 penny above 315, which is critical support. I booked profits, half profits on our short. But what I'm waiting to see here is this. On a weekly chart, is this week a retest of a breakout point and we close above this support level in blue? If we do so, that probably means we're going to see higher highs next week. If we fail to hold support tomorrow and we close down below 315 on the triple Qs, I'm going to load back up on shorts on the triple Qs and expect new lower lows. Yoga Mac, hey, brother. VXX scared me out of the market after I sold through. You got to be careful of the VXX. It's a broken product. It's really, really bad. I shared it the other night with members that the correlation between the VXX and the VIX has really fallen apart. So be careful there, pal. You're probably best to be out. So that is the Qs. The banks still a down week off their lows by a half percentage point. Volume light. Let's keep it going. XLK. How much time do we have left here? About 15 minutes. XLK trying to break through resistance. Now, XLK is technology, but still down 2% on the week. The semis, a very bullish setup here. Very, very bullish. I mean, if we close out the week at where we closed today or higher, pretty bullish stuff here. The semis should rally. But to be fair to myself, I said back here, because I put out the best stock charts for the new trading week 2 weeks ago, and the SMH was one of those stocks or ETFs. And I said, this should continue higher. And it did. The problem is it couldn't maintain the gains. You had sellers move in and they sold strength, driving it back down to its support level again. So right now it's a bullish week. We'll see what happens by the end of business tomorrow. Volume to the upside is very light. Wait until the end of business tomorrow before you do anything. That's my suggestion. I can't tell you what to do, but that's my suggestion. Biotech setting up for a continuation run higher. We booked profits on LABU back here last week. 3/4 of our position off the table. We're still long of it. I'm probably going to sell naked puts here and leverage back up on LABU. Energy. Folks, the correlation between oil, natural gas, especially oil, and XLE is very, very highly correlated. So you could bet your bottom dollar that if energy is moving up higher, they're expecting higher highs on energy prices. So what's oil doing? I don't know. Let's take a look. So oil is certainly pulled back. But this week, oil, one trading day left to go. Maybe it's not going to happen. But at current, at this snapshot in time, Thursday night, we have a breakout on a weekly chart. So why does this all matter? Remember why the equity market began to rally. CPI came in less worse than what was expected. Biden came out, said, freaking potato. He came out and said inflation is zero. That's what he said, zero. Because there was no month-over-month change, I believe at the core or on the headline, one of the two. The only reason why there was no change on CPI month-over-month is because of this chart here. You saw a reduction in oil prices. Look no further. This is the why. If we begin to creep back up, well, what happens to CPI when if we break out here, the higher prices for oil, natural gas will be reflected not in the August data because August is almost over. It'll be reflected in the September data. So we may rally for the next couple of weeks on the markets if we have a technical breakout, But come September, excuse me, October, if you see oil prices moving higher, yeah, bet you better bottom dollar that institutions are going to be selling in advance of that CPI report, because I will be, because we know what drives that CPI report. It's oil prices. So we know food prices are headed back up as well. In fact, let's take a quick look at the DBA, the agriculture ETF. We are up 2%. This is a big move for the DBA. This thing doesn't usually move all that much. Up 2% on the week. So oil prices on the week breaking out. Food prices on the week up 2%. Natural gas prices up over 0.75%. We have a position here. We're long of oil. This is a leverage ETF. So natural gas prices. Look at the technicals here, folks. This is a weekly chart. You always hear about the death cross, right? The 50-period moving average crossing below the 200-period moving average. That's the death cross. Nobody ever wants to talk about the positive convergence of the 50-period, and really first is going to be the 20-period crossing above the 200-period. Once you get this, what you call the stacking of the moving averages, 5-period moving average, or 5-day or 5-week moving average on top of the 10-period moving average, the 10-period above the 20-period, 20-period above the 50, 50-period above the 200-period moving average. That's called the stacking. Once you get that, you get all sorts of money flows moving in, momentum traders moving in, because the averages are telling you which way the money is flowing. Folks, pay attention to this. Natural gas prices, a la Europe, because of their bonehead response to the Ukraine, they are going to sap our natural gas supplies here in the United States, which are already below what we need. We are exporting natural gas over to Europe. Look no further than LNG, Genera Energy. LNG stands for liquid natural gas. That's how they transport it. Look at this. Look at this chart. This is not because of United States demand. We're powering Europe now. Take a look at Golar. Golar natural gas on the precipice of breaking out. It's already broken out. This has got to be bought. So there are going to be bull markets in this next leg down in the market, but you need to look at commodities, especially if the dollar breaks. Gasoline prices. I haven't looked at this one yet. Gasoline prices are down on the week. So distillates are not yet moving up higher. One trading day left to go. Gold. Gold prices up nearly a 0.5 percentage point on the week. I think what we have here is the beginning of a higher low on gold. We're looking for a breakout. If we close above 17, let's call it 1780, 1790 on gold, that'll be a weekly breakout. And you got to expect we're going to see a resumption of the rally. And we're probably going to take out all-time highs in short order if the US dollar rolls over. As for the gold mining stocks, Nugget, I talked about this, so I'll go to Nugget. Another instance where you have a higher low. We're setting up in a triangle formation. We closed above. I told you earlier, I bought back our covered call position. We had a small profit there at the 30.50 strike. And I'm glad I did, because we closed at $30.56. So the probability of those shares being called away from me was very, very high. Let's do some chart requests. What about Boyle? Crazy reversal bar on Tuesday. Yeah. We have I have a strangle open on Boyle. And I was so worried about the position that let's go to Boyle for a moment. So my strikes are down here. I think I'm at 68, if memory serves. On the put side, I sell for premium, and I'm at 160 on the call side. So I sold the premium. Now, the thing is with the puts, they're not paying that much on the puts. And there was a lot of premium in those calls. And I was worried about a huge binary breakout on natural gas. So what I started doing was buying the common shares. Now, we're only at about 25% of the naked call position that we have on at current, but it's enough to hedge the position at current. If we break out above 123, I'm going to need to buy more, and I'll be net long of Boyle at some point in time, because I think the natural gas prices are just going through the roof. Devin? For this, I'm going to use TrendSpider because it's not showing me all of the resistance levels above, and I want to get through as many as possible. And TrendSpider just lets me do it quickly. Folks, if you're not using TrendSpider, automated technical analysis, literally automated technical analysis, link below, 35% discount code, TrendSpider. I mean, what can you say? It's going up. It's going up. So this is what I was talking about earlier about stacking of moving averages. All the moving averages are going in the right direction here. So it's looking very good. We broke out on the week. What we may do next week is do a retrace. No guarantee that that's going to happen. And that's an area. I'll share with you the price at that's at in a second, at around say 68.75 to $69 a share. RSI rising and going in the right direction. Daily view. It's going up. It's going up. Bullish. It's going up. MOS for Mr. Lewis. Mosaic looking great. The only thing I would worry about is, again, another retrace because it broke out on the week. A retrace back down to this automated trend line in blue. Click of a button. Keep this active for a while because you're going to get corrections. We broke out on a daily time frame yesterday. Today, a retest of the breakout point and a reversal bar. Mosaic going higher. Boyle. Boyle already went over. Boyle is in a trading range right now. You have a lot of resistance immediately above at 127. These are all automated trend lines, folks. I did not draw these lines. The computer did it, right? So the line in green, line in red, it's the algorithm telling you got resistance above. You start breaking out. I drew this line here in green. If you start breaking out above 123, get ready for a rip-roaring rally on NUGT. I think this could be bought. We're bouncing off of the volume-weighted moving average in orange. You can see this is a nice consolidation. I would nibble here, buy more on the breakout, and I'm speaking. Excuse me. What is the phrase? I am preaching. I'm practicing what I preach. I'm practicing what I preach. I am buying the shares of Boyle so that I can enjoy the run up and protect my naked call position. And I have a naked put position as well. So Boyle looking good here. Consolidating. I think it goes up higher. Down on the week, though. You have resistance above. Simple as that. But I would stick with the trade. PAAS. Oh, silver. Yeah. Interesting. A down month. Few trading days left to go. All right. So note what I just did here. I want to take this off. Note this. Keep an eye on this blue line here, the dashed blue line. We're on a weekly chart. I'm going to take this off. Now that blue line's gone. What that blue line represents is on this weekly chart, I'm able to overlay monthly support or resistance, both. In this instance here, the TrendSpider functionality has allowed me to identify, while looking at a weekly chart, the fact that on a monthly time frame, we are back above support. Do we close there? I don't know. Several trading days left to go in the month. A lot can happen. Could be yes, could be no. I don't know. But you want to take this observation and pay attention to it. Watch it. It's certainly worth the watch, because this is a significant event, because we broke down below that support level last month. If we close back above it this month, that probably means Pan American Silver is done going down. That's step one to a new bull rally. You got to stop going down. Daily chart. Now, again, on the daily chart, I still have the monthly overlay here. And we are back. In fact, we broke out above it yesterday. We did a retest today, and it held. So this is looking good. Just keep in mind, you're going to have resistance up here at around $18 per share. How do I know? The algorithm. So PAAS, I can never do that right. Looking good, but speculative right now. That was me, not the software. Fold. Why does this sound familiar? Fold. Oh, Amicus. Oh, that's why. Okay. It's a good looking chart. It's a really good looking chart for several reasons. This is a monthly chart, and draw your trend lines however you want to draw them. Right? You have 1278, your magic number. Long story short, we can cut this down to one single number, $12.78. Why? Well, $12.78 was support back here. September 20, support back here. June of 20, resistance back through here. Last seen in June. Is it June? Oh, January. I was like, wow, that's way too many candlesticks. January of 22. And now we're back up there again, where we saw a rejection on the month. We close above 1278. This is a buy. Weekly chart. Again, we're struggling at that 1278 mark. 1278, mark it on your books. We were above it. We gave it up. If you wanted to nibble on it, look to nibble down here at $12 a share. Be small, then buy on a close above 1278, ideally on a weekly time frame. A close above 1278. Currently doing yard work after a long day at work. Lucky you. Hi, Bob. How do you weather the buying today was institutional or trade? It's simple. You look at volume. So volume will tell you the entire story. Volume is very light. It's not indicative of an institution going in and loading up on shares. And the reason why I learned to appreciate volume was that William J. O'Neill, who's the founder of Investors Business Daily, IBD, He wrote a book. It was one of the first books I read on technical analysis and appreciating the value of price action and volume action. And the metaphor he used was volume is like an elephant stepping into a bathtub. So you have the market, which is the bathtub, and an elephant is your institution. So the water goes flowing over, lots of volume going into the market. Now, an individual, they can't really cause that, right? It's because you're an individual. You don't have that rocket fuel. You don't have that buying power. Institutions, they drive the market, not the retail investor. Can you please tell me what's considered high beta? Yeah, Pete, if you go to like Yahoo Finance or you go to IBD, Investors Business Daily, they'll give you a beta read, right? So rule of thumb, it really, first off, it depends upon you. How much can you take? But if you're going to go by the institutional definition of what is high beta, for those folks not familiar with what beta is volatility. How much volatility or how volatile a stock is. The number to watch, or the institutional definition of high beta or high volatility, is 1. Anything 1 or higher is considered high beta. Anything below 1 is considered low beta or medium beta. Franklin, you're welcome, sir. Thank you for being here. Thank you for your comments. And thank you all for being here. Folks, I owe it all to you. It's my pleasure being here. Thank you. If you could hit the like and subscribe button, it would help me out a lot with the YouTube algorithm. 14-day free trial offer to the Contrarian Trader gets you TrendSpider for free, silver and gold level members. Everybody have an awesome, profitable trading day tomorrow and a great weekend. I'll talk to you soon. Be well.